Hi, everyone. Thanks for joining us today. I'm going to give just a couple of minutes for others to join us. I can start to see it filling up. So let me give it a couple of moments for everyone to kind of come in, and then I'll get us kicked off. All right, let's go ahead and get started. We'll have others kind of pop in as we go, but let's go ahead and get started today. And just so y'all know, we do have the chat box open. So if you want to send me questions throughout the presentation, feel free to place them there in the chat box, and I'll try to answer as many as I can. If there's one that I don't get to, we'll certainly follow up with you afterwards to get an answer out to you. So thanks for joining. Today we're going to talk about net unrealized appreciation, or NUA, as I will abbreviate it throughout today's conversation, and also just hitting on some other post-retirement strategies as well. My name is Morgan Veth. I'm here in the McLean office. I'm a Vice President Financial Advisor here at Bogart Wealth. And I'll kick off by talking a little bit more about Bogart Wealth before we dive into the presentation today. So at Bogart, we are a registered investment advisor, and really our mission is to help clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. We do that as a fiduciary, so we are beholden legally to act in the best interest of our clients, which we do every single day. We currently have a little over 2.1 billion assets that we manage, and we are very proud to support well over 1,000 households and families. Just a little snapshot of who we are. So here's the advisors that we have at our multiple locations, both in Texas and in Virginia here. Our team that keeps us working like a well-oiled machine is our operations and planning teams here in the headquarters here in McLean, Virginia. And of course, we have our management team and tax team as well. So a couple of the things that we'll go over today hit on a lot of these different categories, but at our core, the foundation that we want to have for all of our clients is a financial plan. We do them for free. We would love to do one for you if we haven't before. And it's where we're really able to go in and look at a number of categories and kind of more nuanced strategies like NUA and Roth conversions and so forth. But we would love to do a plan for you. So feel free to reach out, and I'll share ways at the end that you can reach us if you do want to have a financial plan, or if it's been a while and we need to update one, we'd love to help you out and do that. Here's our 3 different offices. Again, I'm sitting in sunny today, McLean, Virginia. But thanks to Zoom, it doesn't matter geographically where you are. We would love to meet with you, even if you aren't near one of the locations to come in person. We can certainly have a consultation over Zoom. So let's talk about, before I get into what is NUA and some examples, so we're going to go pretty in depth. I would be remiss if I didn't start off by talking about the 2 different types of accounts that you can hold. Generally speaking, there's qualified and non-qualified. So that'll help set the stage for the NUA conversation. So a qualified account it's a 401k, i.e. your savings plan. An individual retirement account, 403b. So anything that is a tax sheltered qualified account is what we think of. And so really, a lot of the benefits are, your salary can go in pre-tax. So you're effectively reducing your current income. No tax on appreciation until withdrawn. So while it's in that tax sheltered vehicle, you aren't going to pay tax until you start to take the money out. So dividends, capital gains, any of the trading or investment income that's generated within that plan, all sheltered. And for most people, they also receive a company match. So usually a very, very good reason to participate in your qualified 401k or savings plan. The other part, I guess we don't want to call it the bad part, but the opposite of good is, there could be a tax penalty, 10% for early withdrawals, because the qualified account is a retirement account. That's what it's earmarked for. So they're really trying to disincentivize you from taking it out before retirement. Every dollar coming out is taxed as ordinary income. You promise to take every dollar out while you live, and the government enforces it. Strong phrases here, but really both of those are alluding to and referencing required minimum distributions. So Secure Act pushed it back a little bit for us, but there is an age at which Uncle Sam says you have to start taking money out of your qualified plan and, of course, paying taxes on it. The way that it's enforced is that it is calculated. So the IRS had some actuaries come up with a lifetime table that we use to calculate your required distribution in retirement. That divisor goes all the way up until 2, meaning you need to take 50% of your account out at the ripe old age of 120. So yes, their intent is that you are spending it out. I haven't in my 16 plus year career had a client go to that age, but there are required distributions to come out and a penalty if they don't come out on time. So in contrast, a non-qualified account, non-retirement account, brokerage account, savings account, anything that isn't tax sheltered or tax beneficial is considered a non-qualified account. And so as such, there's no early withdrawal penalty and there's no RMD. So there's no one to tell you, hey, here's the earliest you can touch it, and here's when you have to start taking it out. It's very flexible, a brokerage account. Appreciation is taxed as capital gains, which the rates are more favorable, and we'll again dive into that much deeper, as capital gains rates are typically 40% lower than ordinary income rates. The other side of it, or the flip side to think about, is that all investments are on an after-tax basis. So you're not getting a deduction for that money you're putting in, and you're also going to pay tax each year on that investment income. Even if you have a dividend that's reinvested, you don't take it and spend it, you still have to pay tax on it, and it's reported on a tax form that year. So you're paying taxes as you go along, depending on your investments that you have, and no company match for that type of account. So these are kind of two different accounts. Again, very important when we're talking about net unrealized appreciation, as it is a complete tax optimization strategy. It's not for everyone. Could be for many of you, especially where the stock's trading right now, but it's not for everyone. We're really trying to optimize taxes, because effectively what you're doing are taking shares from a qualified account and putting them into a non-qualified account. So just setting the stage there. So as I got ahead of my slide here, what is NUA, right? So it's when we're taking assets from the qualified to a non-qualified plan. There's some caveats. It only applies to your employer stock. Only applies to the employer stock. So for many 401ks and savings plans, I've seen a lot in my time. Even if I find a lot of clients who are working for, publicly traded large organizations, doesn't mean they always offer them company stock as an investment option within the 401k. So it is kind of a smaller group, growing, but smaller group of investors that this is even an option for. So it has to be your 401k, it has to be your employer stock, and must be part of a lump sum distribution. So you can't kind of cherry pick and do some one year, some another. So it is a one-shot deal that you're doing. You're taking it as a lump sum distribution, and there has to be a qualifying event. Here's a number of the events that would qualify for you to be able to take it out. I would say NUA is so tricky in the sense that you've just got that one time to do it. we really encourage you to work with a professional before you do utilize NUA or take it, whether it's us or another financial advisor, hopefully us. Please do sit down with a professional just to make sure that you've had one of these qualifying events and that you are eligible to do NUA. Most clients, as it is when you are having a qualifying event and you're removing everything, I would say most people are doing it at retirement. So when you're leaving the company, that's typically when you're making this choice. So the way that it works is, let's just say for ease that the current stock value is at $100 and the cost basis is $50, just to kind of keep it simple. So trading today at 50, you paid 50, trading today at 100, you paid $50 when you put the money into the account and purchase within the qualified account. So the difference there, the $50 difference, is your unrealized appreciation, right? It's appreciated and gone up by $50 per share, and it's unrealized because you have not paid tax on it at this point in time. So that is at its simplest what NUA is. Where's it trading today minus the cost basis that you have within the plan. It generally is more attractive, and we really start to look at it when you do have lower cost basis. So if the stock's trading, at or even very close to your the cost basis within the plan, usually doesn't make sense to do NUA. The greater the spread here, the greater the appreciation, the more compelling it is to look at and simulate doing NUA. So again, pretty simple example here, but if you take the money, leave it in your 401k or your IRA, every dollar coming out is going to be taxed as ordinary income, versus if you do NUA, let's use the example that I was just talking about there. The cost basis is taxed as ordinary income, and then the appreciation gets to be taxed at capital gains rates because we are putting it into a non-qualified account. And that differential, that's really what we're looking for. That's the whole point. And the benefit is to say, hey, versus ordinary income rates, how much can we get out and pay a lower capital gains rate for you? That's what we're solving for. And this just breaks it down with some numbers, but we're going to go into some much more detailed examples. Don't worry. So, and this just outlines, as I talked about, the difference, right? So most people think capital gains rates are 15%. For many people, they are. For the vast majority, they are. Actually, some are taxed at 0%. So there's a way, if the income's low enough, to not pay any capital gains. 15, again, serves many, many people. And then if your taxable income's high enough, it actually goes up to 20% is the highest capital gains rate. To contrast, in current tax law, the income brackets, the federal brackets, go up to and top out at 37%. So the difference is what we're trying to benefit from here. So this shows you, again, very basic example of what it might look like if we do NUA, and I'll show more in a minute, but we've got the savings plan. If we're going to do NUA, we pull it out to that non-qualified account here. We've labeled as joint account. It could very much be an individual account in your name, a trust account, however you want to have it registered. And then anything that we're not doing NUA on, or common assets, the other units that you might have, those all go into an individual retirement account. But again, got to happen all at once within the same year, within the same calendar year. So let's go through. So we've kind of talked about the different rules that needs to be a lump sum. Let's dive in and take a look at a statement that might look familiar to you. It is an example. And so we're going to go through some things to read and look at on the statement, and then kind of play it forward to see how NUA would benefit someone. So for the employer stock, right? So again, anything else, equity units, any other mutual funds, common assets, NUA is not even eligible for them. So really what we're honing in on is the employer stock within the plan. You'll also notice on your statement, usually this is on page, bottom page 2 or 3, I think, but after-tax contributions. The reason I'm bringing this up is they are a way that could possibly pay for NUA, and we'll get into that. But here's your after-tax contributions. You see this big arrow saying not this. I find that a lot of people look at their after-tax account and go, oh, after-tax is $562,000 in this example, quite a bit. It's not. What you really want to look for is in kind of this bottom left corner here, right? So it's about 274 in this example. This is truly the after-tax money, the basis, the money that cannot be taxed again. The difference in what you're seeing here versus the after-tax account is that this number with the after-tax account are the contributions and any earnings that are associated with those contributions, but they have not been taxed. So your true after-tax money that we're looking at when we're going through the plan, again, let's call it $274,000 in this case. With the after-tax money, you've got a couple of options. You can withdraw it. Hey, you already paid tax on the money, you can take it out. You can roll it into a Roth. This is, we say new option, I guess in 2023, it's not as new, but still newer, but there is an option that you can say, hey, I want to take my after-tax money, the contributions, move it to a Roth IRA where it's now growing tax-free. Sometimes we conclude that in certain situations, that can actually be better than NUA, especially as it states here, if you're not going to sell the ExxonMobil stock, because the benefit we're driving from NUA comes when you sell it at the capital gains rate, when you actually have the taxable event, right? That's when we're realizing the benefit. If you don't want to sell ExxonMobil, if that's not something that's going to happen, then having it grow tax-free and a Roth could be a better choice for you. Or again, as we'll show in the example here, you can apply it to the cost basis of the NUA shares. So withdraw it, move it to a Roth, or apply it to the cost basis for the NUA shares and pay for those. This shows just a screenshot again of the how we can see the basis for each individual lot. You might not even realize how beneficial this is and huge that it is. Of all the plans that I've worked with that do offer NUA or do have company stock within the plan, again, that in and of itself is a smaller subset. I don't know that I've come across another plan, maybe one, that actually shows you the itemization of each specific lot. Most plans blend it together just to give you, here's the average over time, but it is incredibly helpful because we can be very selective and intentional when we're doing NUA to really select specific lots and specific shares with the lowest basis. So huge, huge, huge that y'all can do that. So let's look at a more detailed example. So here's how it would look. We've got the savings plan. Let's say for this particular scenario, we're going to do NUA. We're going to declare NUA. Those shares, again, go here into the non-qualified account. If there are shares, let's say in this example, that are above and beyond what we're going to declare NUA on, because it isn't all or none, right? We can be selective with those shares. So for the non-NUA shares, we'll move those. You stay invested the whole time, just move them into an individual retirement account. For anything that is pre-tax money, but not ExxonMobil shares, so common assets, units, et cetera, that also goes into an individual retirement account or an IRA. And then if you do have Roth, because there is a Roth option to contribute, so you might actually have a Roth source within your savings plan, or there could be a surplus of after-tax money where we aren't applying it all to the Exxon basis. If there is a surplus of after-tax money, we'll move that also to a Roth IRA. So here's what you could end up with, these 4 sources and classifications of accounts. And again, this is just using some numbers from the example to go with it. So here's the amount of shares that we declared NUA on. you know, there's a couple of extra non-NUA shares that would go into the IRA, and then everything else just goes into an individual retirement account. So if we were to declare NUA, and this just kind of really goes through the numbers, let's dive into it. So in this example, the average of those 6,452 shares, again, we'll get specific, but the average cost basis of the ones that we're going to declare is $29.46. So here's the cost. Now, no matter where the stock price is moving around, as we've seen quite a bit over the past year, the cost basis doesn't change, right? That is a standard thing. So here's the cost basis, here's the number of shares, so here's the cost. In this example, the client had tax paid portion, she had 187,000. So of the 190, we're covering the tab or applying that after-tax money to the basis. So covering quite a bit of it. The delta in these two, so the small extra, the $3,032, is just going to be taxed as ordinary income, right? So this money's been taxed, it's applying, the difference is taxed at ordinary income. I'm going to assume in this case a federal bracket of 35%. So $1,000 is what it costs to just realize the NUA. Well, then, as we said earlier, the benefit comes when you sell it. That is really when we're realizing the benefit of NUA. So in this scenario, here's the shares we declared on the previous slide, $100 a share. So here's the basis that we have on file. So that's your capital being returned to you. You cannot pay tax on that again. So the difference, $455,124, is all taxed at long-term capital gains rates. So I take the shares from the plan, they go into my brokerage account, we turn around and sell them at $100 per share. This is the tax scenario. So again, assuming 15%, it could be, you know, up to 20%. So I'm just going to use 15 for the purpose of today's illustration. The tax you're paying when you sell the shares, a little over $68,000. So with NUA, this is the number of shares you took out. Here's your gross number. Pay a little bit of tax because our tax paid didn't quite cover our basis. And then here's the capital gains when we sell the shares. So all in, we net $575,000 with this transaction specific to NUA. On the flip side, if we don't do NUA, we leave it in the plan or in an individual retirement account, a qualified account, and we go to take out the exact same amount, $645,200. Again, dollar for dollar, that is taxed at ordinary income rates. So again, assuming 35% here, you take out 645, but what you get to keep is 419,000. Oh, one quick question I had here. So the question was, remember, y'all can use the chat, but I just had one come in. If I don't have any tax paid, can I still do NUA? Yes, you absolutely can. So we try to utilize the tax paid balance if it's in there. But if you don't have any tax paid balance, that does not mean you cannot do NUA. We have a really great proprietary tool that we can go through to kind of simulate and show. So it doesn't mean you can't do it if you don't have a tax paid balance. So great question. All right, so let's look at the two. So running these side by side. So with NUA, I got to keep $575,000. Without NUA, in that scenario, I'm keeping $419,000. So the difference you can see, which again is just kind of that tax difference, we're assuming we trade at the exact same price in both scenarios, is $156,000 is the benefit to NUA. So some of the sensitivities and considerations around doing net unrealized appreciation. So factors for favoring more NUA is if you feel, if you're bullish on the stock, on ExxonMobil. So if you think the share price will rise in the future, again, more of a case for doing NUA. Plan to use it sooner. So we've had quite a few clients where, in the early years of retirement, at the beginning, there's been, big home renovations or buying a second home, education bills, right? You're still writing the check to the university for the kids, where they do need, kind of a larger lump sum amount in those early years outside of their normal cash flow. NUA can be a great way to pay those bills and cover that in a much more tax efficient way. Bridging until 59 and a half is another common thing that we do. Expect excess RMD issues later. So I've got to imagine most of you are probably not sitting there going, yes, I know the exact excess amount of my RMD I'm going to have in 30 plus years. We solve it for you. So part of the planning that we do that I mentioned in the beginning is that we run a very, very detailed cash flow analysis all the way until your 90th birthday or longer. But we're looking and we kind of map out the cash flow to say, what do we project your required minimum distribution to be? What are based on the expenses that you've given us, and we've inflated those. Let's look out. We can really pick any year right into the future to see what's the required amount that needs to come out, and is it more than what you need to live? If there's an excess there, we should be thinking about NUA if it's an opportunity. We will also do quite a bit of Roth conversions as well. That's a common strategy that we use to even out taxes, optimize taxes, and really mitigate the RMD excess issue, if you will. So factors favoring less NUA, if you think that the share price is going to fall. I think if you really thought it was going to fall, you probably wouldn't continue to hold it, but I could be wrong. If you've never planned to sell the shares, NUA doesn't really make sense. Or if you have a preference for it to go to a Roth IRA. Those are some of the reasons that you would not utilize NUA. So just to kind of think it through again and summarize here. So really the advantages are taxed at long-term capital gains rate, not subject that the money that you bring out into the brokerage account, non-qualified account, is not subject to RMDs. It's much more liquid. You don't have that 10% early withdrawal penalty. And again, if you've already got that tax paid balance, you can think of it as savings already kind of set aside to cover it. So it's really not going to impact and increase your tax bill if we're using that tax paid balance. Disadvantages are, cost basis taxed at, ordinary income rates. Again, if we're not using the tax paid, then yes, we are having to realize the basis and wrap that into the current tax bill. No benefits of tax deferral on the growth. So once you bring those shares out, as long as you're holding the stock, those dividends that you like to see, they're taxed, right? Significant amount of employer stock leads to a less diversified portfolio. So we are often helping to kind of unwind the portfolio, regardless of the company name. If you place any name in there, we want to be very aware of any single stock exposure. So we are always going to be in favor of diversifying the portfolio and getting the stock down to a reasonable, manageable amount, right? Usually 5 to 10% of your portfolio in any one company stock. And then dividends taxed at qualified dividends rate. So again, any income that's being driven after it's in the brokerage account, it's taxable income to you. So let's move on then. So that kind of covers really NUA. Let's talk about some of the other strategies that you could think about, and some items even, pre-retirement kind of leading up to. So reviewing your contributions. Again, when you put money into the savings plan, are you doing pre-tax versus after-tax versus Roth, and what makes the most sense for you? We can quantify and show you what's the better mix to be doing, review NUA share cost basis versus tax paid, save more. I guess it would not be a financial advisor if we didn't tell you to save more, and carefully consider before selling low basis shares. Now, when you go to place a sell or a trade within the Voya plan, it should be pulling from your highest cost basis by default. I think there can be some nuances with the rebalancing tool in there. But again, ideally, we want to keep the low basis shares if we're going to do anyway. Those are the ones that we want. So sell from the higher cost basis shares first, probably the more recent shares that have been purchased. Let's move on to post-retirement strategies. So we'll talk about tax strategy continued. You can see the underlying message is very much about marrying taxes with the investment strategy, cash flow strategy, good till canceled orders, and cover call strategy as well. So for the cash flow planning, if we're thinking about early retirement, so I'm going to define early retirement as, pre 59 and a half. We'll take it pre that age at which you could take it out penalty free. So, your cash flow, the way to fund retirement in those years could be from savings, with money markets paying, close to 5% right now. A lot of people have kind of shored up some savings. So you might have cash that you've saved up anyway. Part-time or consulting work, if you want to continue to do that and kind of fund or supplement those early years. Pulling from your 401k. There is a rule or exception to all 401k plans. So to the savings plan, this does apply to you, that if you separate service between 55 and 59 and a half, so in that window, you can pull money from the 401k from the savings plan directly without paying the early withdrawal penalty. So one time a year, you can go in and take money out. And so oftentimes, if that, once we've run through the plan, that can be a suggested way that we want to fund those early years. And we're definitely going to recommend leaving it in the savings plan for that reason. So very specific that the withdrawal come directly from the savings plan between 55 and 59 and a half. 72T, which is just a way that you're setting up to take equal payments. We don't tend to use this strategy a lot because it is very, very rigid. And so that's another way that the IRS will allow you to take money out penalty free. But again, not a very flexible way and not recommended typically. And a line of credit. Again, this would be a very, very short-term bridge if we needed to, whatever reason, tap into, a line of credit, whether it's through the brokerage account or your home equity or whatever it might be. With rates are where they currently are in this current interest rate environment, I'm probably going to be hard pressed to recommend that, but it is a resource that you could use very short term if we needed to bridge. And so what we really help you to think about, what we think about for you together is, there's all the different ways I just mentioned, but everything isn't taxed the same way. And so Social Security, for most clients at the top, the maximum that Social Security can be taxed is 85%. So 85%, if your gross amount's $1,000, the maximum amount that can be taxed is $850. The threshold is pretty low. So most clients I've ever worked with are subject to that maximum tax. So Social Security is not dollar for dollar, but the vast majority of it is taxed as ordinary income. Pension income taxed as ordinary income, interest income, if you're thinking about savings account or coupons that you're getting from, a bond, that's typically taxed at ordinary income. The IRA and 401k, as I've mentioned a couple of times, versus qualified dividends, long-term capital gains. So anything you've held a year and a day, more favorable rate. Roth IRAs, tax-free. A couple of things that requirements that you need to hit, some pretty easy ones. but otherwise you never pay tax on the Roth IRA. You also don't in your lifetime have required minimum distributions on the Roth IRA. Roth IRA is a great deal. So we definitely love to focus on that and get some money there when we can. And then liquidation of investment principal. So much like your tax paid, right? You can't pay tax on that money. Again, you can't be taxed twice on that money. So we really go through to set up and kind of streamline, let's think about each year. What are the income needs? We kind of run a 1040 to kind of look at the tax rates for the next 30 years to come up with a optimal cash flow strategy, taking into account how all of these different sources are taxed. And again, this shows a breakdown for capital gains. So if you're married filing jointly, that threshold at which the capital gains start to be taxed at 20% at that higher rate is about $550,000. So $553,800 to be exact. Again, with kind of the vast majority of clients falling into that 15% range for capital gains and qualified dividends. So let's talk about good till canceled orders. So one really, really huge benefit of having the NUA shares, so having the shares out in a brokerage account or the shares in the IRA. So if there's shares that you're taking out, want to stay invested in Exxon currently, and just pull them out to place them in your individual retirement account. A really nice benefit is that you can set a price that you want it to sell. Currently, as you probably know, if you go to sell shares within your savings plan, you don't have as much control over the price you're getting. If I sell today, I'm getting the average price of the shares tomorrow. So with having it in a personal account, we can actually set prices and number, whatever you feel like you're comfortable with the share, probably a range of numbers that you feel like this stock could sell for and that you'd be okay and comfortable selling for. And we can set it to automatically happen. So even if the price kind of touches that number, the stock touches that number for just a bit, the trade automatically happens. It's especially huge, I feel like, when you are in retirement, you're enjoying yourself, you're traveling, you may or may not be tracking the stock every single day to kind of look for that price that you want. So it's a very easy way to say, let's just place a limit order, a limit trade to sell Exxon at a specific price, and good till cancel, just meaning it's going to stay open, right? So that's just kind of on file. A very systematic, easy way to get out at a price that you want to get out at. So that's a good till canceled or really easy strategy, but something that we help with. The other strategy that we use for the stock, again, ideally we're wanting to reduce the concentration in the stock. So a very, very common thing that we also do is a covered call strategy. So within the covered call strategy, you've got your underlying stock. So let's say I own ExxonMobil, premium, which I'll go into an example of what that means, the time frame at which it can sell, and the strike price. So with the covered call, you are saying to an investor, I'm going to sell you the option to buy my stock at a specific price. So you could sell a covered call and say 120. I'm going to offer an investor to buy ExxonMobil at 120, regardless of where it's trading. So let's say the stock goes up to 125. You've got an IOU or a promise to sell that stock to someone for 120. They're going to pay you for it. You're going to receive a premium for that promise to sell at that agreed upon price or strike price. And so it's a great way while you're continuing to hold the stock to, in addition to the dividend, because if we place a covered call or sell a covered call on your portfolio for you, you're still owning the stock, right? Until it gets called away, if it gets called away. So you're still receiving the dividend. And then you're also going to have the premium income in addition as well. It's a really, really nice thing to consider doing. So I'll just take you through, kind of an example here. So again, premium being $5 per share. The agreed upon price here is, again, $120. So you sell these, and when it expires, there's always a time frame on it. When that 6 months comes up, if the stock never went above 120, well, no one's going to try and buy it from you at 120 if they can go get it on the open market at 105, right? So it's just going to expire worthless. You kept your premium. You still have the shares. They didn't cash in, right? They don't want to buy it if it didn't go above that price. If it does go above 120, again, in this example, that'll be the set price that we have. Here's the example. So it's trading at 105 today. We'll say, here's that premium you got. They paid you $5, per share for the right to buy it at 120. And the stock goes up to 130. You're selling at 120. So you're not getting this price per share. You're selling at 120, but you also got the premium, the $5 premium as well. So your opportunity cost in this scenario, if it exceeds that strike price, that agreed upon price, then that's the opportunity cost that you're missing out. So stock goes down, nobody's going to cash in. You just keep the premium. We always want the stock to go up. So I'm not going to call that a win-win situation, but you still hold the shares. You didn't sell any. If it does go above that price, you're selling at that agreed upon price in this case. So not getting the full upside potential. So in a rising environment for the stock price, covered calls are always going to limit the upside potential that you have. But it's a great thing to do that we use for quite a bit of clients who maybe still want to hold on to some. Again, okay to get out at a set price and to bring in a little bit more premium and income for them on the portfolio. So some of the advantages and disadvantages of that. So you can earn additional income while retaining the stock. There is some downside protection, very little, let's be honest. So your downside protection is that, well, you at least got the premium. If the stock goes down significantly, you're still riding it down. So I call that a very light advantage, but an advantage, a great strategy to divest shares, again, to diversify the portfolio. Disadvantages, we're capping our upside. If it gets called away, you're going to be required to sell the stock. It probably seems obvious, right, in the way that I described it, but it can be an emotional thing. And so something to be aware of, that if it gets called away, you're selling that stock at that price. Downside protection limited to, again, just the premium that you receive. So all of that to say, hopefully y'all learned a lot today. I didn't have any more questions that came in, but we would love to sit with you to have a plan. It is for free. We're happy to go through a one-on-one financial strategy to understand, do any or all of these make sense for you, to answer any questions that you might have about your situation specifically, one-on-one. So if you go onto the Bogart website and click contact us, Mindy will reach out to you pretty quickly to offer some times and set up a meeting time that's convenient for you. Thank you all for coming, and let us know if you do have any questions, if we can be helping you. We would love to have the opportunity to sit down one-on-one and create a financial plan for you. Thank you so much.